Now, we go to the next topic, which is Dao Theory. Now, this is something which goes back 120 years. And I would not go a lot more about Mr. Charles Dow, but you know Dow Jones Index, right? So that is the history of it. Then you can go back to an old book written called Reminiscences of a Stock Operator, a book on Jesse Livermore. I suggest that it's a superb read for an investor, for a trader, and it's a book which should be read every couple of years, which gives you the history of speculation, and a lot of principles remain the same. So what is Dow Theory? In simple ways, what are trends, right? So that there are three simple trends. One which is a bull market, one which is a bear market, and one which is corrections or the secondary reactions. Simply put, what is a bull market? Higher tops and higher bottoms. So you go from 100 to 140, come down to 120, go to 180, come down to 150, go to 200, come down to 160. You keep making higher tops and higher bottoms. So that is the simplest way you look at a bull market. What is a bear market? You fall from 200 to 170, go back to 190, fall to 150, and keep doing this lower tops and lower bottoms. So these are the simple ways to understand a bull market and a bear market. So if you look at this chart in front of you, this is 2014 market, wherein the Nifty goes from 6,400 to 9,000, keeps on making higher tops and higher bottoms. You have a higher high and a higher bottom, which continues. Then in 2016, it flips on the other side. It falls from 9,000 to 8,000, starts making lower tops and lower bottoms. So this is the way you signify a higher top and higher bottom is a bull market, a lower top and a lower bottom is a bear market. Very simply put, these are the major trends in the market. Now, all these major trends have phases. So we'll try to understand this Dow theory from a practical perspective of charts, market prices, as well as a little bit of sentiments. So the first phase is after a bear market. So consider a bear market is over. You go into a sideways period of some time where we call it an accumulation phase, where the market goes sideways, continues to consolidate. The markets have fallen a good 25-50% from the top, and then it goes sideways. Now this is the time when valuations have come to a normal period, or they are very undervalued stocks. This is the time where smart investors understand the worst is over, and the prices, suddenly the selling pressure gets absorbed and there is accumulation. Next phase is when after this accumulation, the markets start making newer highs. So it starts making a 3-month high, 6-month high, higher tops and higher bottoms start. Now this is the start of a bull market. Now it will start off with the first high, the second high. By the second or third high, you clearly realize there have been two tops which have been crossed. So say consider the markets are at 100 to 80 zone, right, for a period of time. It crosses 100, then goes to 110, comes down to 105, goes to 115. At 115, 120, you realize the bull market has started. Now, this is the period of time where the markets are doing well and businesses also start doing well. The cycle is over, the worst period is over. So the prices advance as well as the business improves. Now, this is the point of time where everybody participates. And by end of it, you've continued to do this and now the whole world is participating. Now, why are people buying? Because my neighbor is buying. Because somebody else has made money. People get into the markets. The participation increases. There are huge number of demat accounts being opened, etc. Participation goes across institutional, direct markets, etc. And the businesses are doing superb. All the readings which come out on GDP, economic growth, etc. look superb. Credit growth is going on. And this continues. Now what happens after this point of time is, now the markets have done really well, but the markets try to consolidate. They are not going at a similar speed, but all the newspaper headlines are superb, right? Economy is shining, the GDP growth is great, there is public euphoria, stocks are going up crazy. The small cap index is in a very different mood itself. The Nifty goes up 10%, the small cap index goes up 30%. Now this is the classical distribution phase where the major index finds it difficult to make new highs, but the small cap indices, small caps, micro caps go crazy, right? Now this is the point of time where all news are great, but the market price action is not great. So let me take you this example via this cycle of 2000 to 2004. So we had this bull market of 1999-2000, Y2K boom, which was a culmination of all the tech boom across the world, and India also participated in the end. And this was the period of time between 1980s to 2000 when the US markets went up 10-11 times. And by end of it, it was all about IT companies, telecom companies. Post that, the markets fell, continued to make lower tops and lower bottoms, and corrected big way. So then there was a minor pullback, as you see, but before that pullback, there was a panic bottom. So what happens is there are lower tops and lower bottoms. The final fall is pretty sharp and very quick, right? Then you get to a recovery, then you go into a sideways consolidation. As you see, suddenly the range contracts and keeps on contracting for months together. After this phase of this lasted quite a long time in 2000 to 2003, it lasted years rather than months. Then somewhere in the middle of 2003, it starts making a 6-month high. It makes the first high here, as you see above this green line, makes the first top, takes a little dip, makes another top crossing, and this continues for a period of time. So somewhere in this period between say 1100 Nifty to 1200, you'll realize a new bull market has started. Now this continues all the way to 2000. Then you'll see again the last speculation phase is very similar to the panic bottom phase. It is vertical in nature. And in a very short span of time, you'll see a big bump up on the index. After that, you'll see a sharp fall and then it goes sideways. Now what do you see in this sideways period? The markets are not able to make new highs. They're not falling as much also. This is the distribution phase. Now this is the phase of time when the economic news, the newspaper headlines are great. To give you an example, back in 2004, the BJP tagline was India is shining, right? And 10 years later, अच्छे दिन आएंगे, right? So in 2004, because the cycle was great, it was India is shining. Then comes the fall, the markets correct by 25%. There was a good enough correction across the world in 2005. So it was not just because of Indian elections, but this is how it culminates, right? So this is how the cycle plays out. You'll see this something happening very similar in 2008 as well. Let us see that cycle. Now after this cycle of 2004, the markets made a new high in 2005. If you see this chart out here, this is a chart for the Sensex from the 1990s. So the top here in 1992, Harshad Mehta, the Y2K top here, the 2004 top here, and then finally in 2005, you make a new all-time high. So it's taken 13 years of a very sideways market, and then it breaks out into a new all-time high. Now this is called a real bull market where it makes multi-year highs, a long period of consolidation. So the Sensex was 4,500 in 1992, and in the breakout in 2005, it was only 6,500 to 7,500. So for a period of 13 years, the return was barely 50%, not even 50% actually. And if you adjust it for inflation, you've almost lost 50% of your purchasing power. Now the all-time highs continue. It keeps on making higher tops and higher bottoms, gets into a nice channel move. Then in the end of 2007, it goes into that speculation phase. The the Sensex goes up from 17,000 to 21,000, stalls at that 20, 21,000 area. But in that period of 20 to 21,000, where the Sensex has made a 5 to 10% move, in that period, the BSE small cap index was up 30%. So that is the ideal distribution phase where the markets have gone into a huge run and now they go into a stalling phase, but the small caps continue in their momentum. Then comes the first big crack. We fall from 21,000 to 15,300, go to 17,500, 18,000, then again fall below 15,300. Now you know clearly that the bear market has been established, right? So this is how the cycle plays out. Then we'll try to look at all the cycles over the last few years. So we saw this period where you got through this huge up move in 2003 to 2008, then comes the downtrend. Now you'll see similarities across market cycles to be similar. So what we are trying to do is we are trying to understand phases so that how do you participate. So what do you want to do in those three phases? You want to be participating in a lot in the bullish phase, the absorption phase. In the accumulation phase, you want to be increasing your skill sets, you want to be increasing your patience and waiting for the right times. Because in a sideways markets, it is tough to make money because the markets do not have a lot of opportunities. Then comes the bear market. What do you want to do in the bear market? Get into some cash and sit on that cash very, very conservatively. Also, do not deploy fresh money till the time the worst is not over and the trends start changing. Now look at this phase in 2008. The first fall comes in, you get a recovery, again you fall to the same prices, again go back, cannot make new highs, then you start falling again. So the downtrend continues. the Sensex has fallen from 21,000 to 10,000. Then comes the panic bottom phase, very similar to what happened in 2000. We fall from 10,000 to 7,500 to 8,000 roughly in really quick time. And that is the fastest fall you would have seen in a very short period of time. Then for the next few months, it gets into a range of 8,000 to 10,000. Then comes a breakout, you start going about 9,000, 10,000 Sensex, a new bull market starts. So this is the point of time which we call as accumulation. This was between October 2008 to March 2009. Then you go into a higher top and a higher bottom. Then you go into a little slower uptick. And then finally in terms of 2010, you see another uptick, which is a little faster. Then you start making lower tops and lower bottoms again in 2010. And by the time you've made that second or third bottom, you realize the trend is over. So the point is, you don't need to be exactly right. So like in 2008, you can't be selling at 21,000, but if you sold at 18,000 or at 16,000 or at 15,000, you would still save yourself from that further fall towards 8,000, right? In the same way, in 2010, you need not be selling at 21,000. You could have sold at 19,000. You could have sold at 18,000 and saved yourself to that next fall towards 15,000 odd levels. Then you go into that period of 2011, where again the Sensex falls from 21,000. The Nifty, now we look towards Nifty. You fall from 6,000 to 4,500. Then you go into that period of a slow sideways period between 2011 to 13. The index is slowly going up. The small cap index continues to go down. So it's not a bull market. It's not a bear market. It is still an accumulation phase, but the markets have gone nowhere. Then finally in 2014, this sideways period, a big breakout happens over a 6-year period in 2014. You cross above 6,400, go to 9,000, higher tops and higher bottoms continue. Again, by 2015, what happens is the markets have continued. We go into a nice phase. The markets top out on the best possible news. You get a surprise rate cut and the markets top out. Then you go into a sideways phase again between 2015 to 2016. You continue to go down slowly and steadily. Then again, this channeled move turns into a little bit of a bull market, a shorter term move between 2016 bottoms to the rally. So you go from 9,000 to 7,000. Then you make this channel in this move, break out above that 7,500, 7,700, go into a rally back to 9,000. Then again you go into a sideways accumulation zone in 2016. Demonetization happens, US elections happens, and we create a bottom. Then again we start off to this channel breakout and a new bull market starts in 2017. Now again, if you notice, what happens is the worst of the news will create the bottoms, the best of the news will be creating tops. So when demonetization happened, the Nifty made a bottom at 8,000. Would you have expected that from after demonetization, you get the best bull market in terms of hardly any drawdowns? So January 2017 to end of 2017, none of the bull markets across the world actually fell by more than 10%. So the full year was a clean up move across the world. We barely had an 8 to 10% fall. Now, was it because of demonetization? I don't think so. The world did not see financialization, right? The demonetization only happened in India. But all the cycles are same across the world. So 2003 to 7, the world went up. 2014 to 17 also the world went up. 2017, we got the cleanest bull market across the world. Then this continues up till 2018. The small caps go crazy by end of 2017. The index continues to stall, but the small caps go crazy. Then you get this fall in 2018. Then you get the LTCG actually coming in. 2016, the rumor created bottom. Actual coming in of LTCG created the top. And then we go into a sideways period again, right? Which was a slow and steady period for the Nifty, but the broader markets did not do as well. Then comes the quick downtrend of 2020. Now, this was an unusual one because we got a 40% fall, but there was hardly any accumulation phase. We just reversed into a V. Now, this was a situation which was not purely, say, all the bull markets and bear markets are driven by human psychology, leverage, liquidity, etc. But the 2020 bear market was created by a scenario which was not really something which came out of human psychology. It was in terms of nature. So we got a fall, but we got a quick recovery also. And that is where technical helps you is after a few higher tops, you accept that you've missed out the accumulation phase and a new trend has started. And this continues. Then you go into a nice phase in 2021. Now in this phase, we see small caps going crazy. You see a lot of craziness across the world. There is this huge craziness for technical companies. There is Bitcoin, cryptos, etc., which have gone crazy. And then we've gone into a sideways phase. And now we may again be starting a bull market in India, but not so a bull market across the world as yet. So, simply put, what does it tell you? Once you understand these phases, you are able to participate. Like 2021 to 2022 was a very similar sideways phase like 2015 to 16 or 2010 to 11. So, when you look at historical charts, the perspective which comes from Dao theory allows you to be patient across cycles and what to focus on. So, for example, when we talk about this sideways phase, how do you make money in this sideways phase? That is where we look at sectors. We have this whole presentation as well as a course where we talk about sectoral leadership in that course. So, you can go through that course. It tells you how to participate in a sideways period. We'll try to, in this particular series, we try to cover how to participate in bull markets and how to save yourself in bear markets. But there is a sideways phase also which can be capitalized as a technical analyst. So, to sum it up, what are the phases in Dao theory? There is an accumulation phase. There is a huge absorption phase where everything is hunky-dory. Then there is a distribution phase where news is great, but the market price is not great. There is a stalling of markets. And then comes the fall. So, and then starts a downtrend. So, these are the three major trends which you are looking at. So, to sum it up, in accumulation phase, what do? Be patient, increase skill sets to be able to capitalize in the next cycle. In the absorption phase, go aggressive. Be all in, all through till the time higher tops and higher bottoms. The absorption phase, all you need to do is sit tight on your equity allocation and keep trading momentum all through that period. Then comes the distribution phase where you will get the signals and you have to stop yourself from being overly aggressive. And on the way down, when you start making lower tops and lower bottoms, you get into a downtrend. So the reason we look at Dow theory is every time you are there in the markets, you ask yourself which phase you are in. So if you realize which phase you are in, you will be able to act accordingly. Like in the absorption phase, you want to do what? You want to buy small caps, mid caps, you want to trade them, you want to invest in them. So that is where the when part comes in. So that's why we take Dow theory, so that you want to participate in the absorption phase. So going forward, we'll try to see this absorption phase in the small caps as well.